Welcome to the October Market Thoughts video. My name is Maria Considine King, and I'm joined by Brad McMillan, Chief Investment Officer at Commonwealth Financial Network. Brad, we've seen the U.S. economy slow over the past couple of months after a strong first half. What's causing this, and can we expect growth to revive?
Well, we did see a strong first half, Maria. We saw demand start to revive. We saw consumers and businesses start to believe in the recovery. And what's happened since then, particularly in the past couple of months, is uncertainty. There was a belief that a lot of different problems were solved in Europe and the U.S., and it's recently been brought back to everyone's attention that that is not, in fact, the case. In the U.S., the best example is the fiscal cliff. As the political process evolves, the fiscal cliff is becoming more and more apparent, and the reality that taxes are going to go up in some way, shape, or form and spending is going to go down over the next couple of years is starting to depress people's expectations of growth. Not only that, because you do have the uncertainty of exactly how that's going to play out. Businesses are postponing decisions, which is why you've seen hiring start to decline, which is why you've seen consumer spending start to level off. This is a problem, and it's not going to go away until that uncertainty is resolved.
The pending election has focused people's attention on politics and economics. What economic and market impact can we expect in the next month or so until the election?
Well, I think the big one is continued uncertainty. We don't actually know, for example, if we're going to have a different government going forward. At this point, it appears that by and large the government will be the same going forward, which means we will have to deal with the same problems and same uncertainty we now have, which of course is weighing on people. At the same time, we do need to have policy changes going forward. The Fed, for example, is probably done at this point about all they can do, which means it's over to Congress for future stimulus, if any. Given the political climate, that appears to be unlikely. Given the need for what we need to do in terms of raising taxes and cutting spending, again, that's going to have a negative impact on growth going forward.
The Fed and the European Central Bank have stepped in with big support programs that caused the markets to rally. And the Wall Street Journal commented, right now markets respond more to central banks and government intervention rather than straight economic signals. What do you think about that?
I think that's exactly right. What we've seen this month is a classic example. In each of the iterations where the central banks have come out and said, we're drawing a line in the sand, everything's going to be okay, the markets have rallied. Only to start to decay after some time when the markets realize that, well, this has not really solved the problem. This most recent iteration with both the Fed and the ECB, they came out, they made very, very, very strong statements, and the markets rallied. But even it's been a matter of days or weeks, and that rally has started to decay. So the gains from governmental intervention, from ECB intervention, are becoming less and less each time, and I believe we may have hit a turning point with that.
Housing seems to be the one economic sector that is showing strength and momentum. But how well can that be sustained if other sectors like manufacturing continue to be weak?
The reality of housing is we hit an unsustainably low level in terms of valuation and demand. Just as we had hit an unsustainably high level before and it dropped down, we now seem to have hit an unsustainably low level. So we're not recovering to a level that reflects a raging market. We're recovering to a level that reflects a minimally healthy market. Because of that, and because economic activity does continue to grow, albeit not as quickly as we would like it to, I do anticipate the housing market continuing to recover. Not only that, because of the near record affordability levels and the demographics, in other words, households continue to form no matter what the economy does. People continue to get older. You have an underlying demand generator that's not going to go away, and you have substantial pent-up demand, which should support continued recovery.
Thank you, Brad.
Thank you, Maria.
And thank you. Please join us next month for the Market Thoughts video.